Navinder Singh Sarao sits in his childhood bedroom in Hounslow, West London, watching $1 trillion vanish from American markets in minutes on May 6, 2010, 2:45 p.m. The trader who triggered the largest market crash in modern history wasn't operating from Wall Street. He was working from his parents' suburban house. Sarao didn't hack the system or break it. He simply exploited it, using Wall Street's own infrastructure against itself. 5 years before the flash crash, Navinder Singh Sarao was living in Hounslow, West London. A math prodigy who had dropped out of university, Sarao had gravitated toward futures trading, a world where pattern recognition and speed could compound into outsized returns. By 2009, as global markets recovered from the financial crisis, Sarao began developing algorithms to exploit a specific vulnerability he'd noticed in the E-mini S&P 500 futures market on the Chicago Mercantile Exchange. E-mini S&P 500 futures were electronically traded contracts 1/5 the size of standard S&P futures, based on the Standard & Poor's 500 stock index. In 2009, the E-mini had overtaken the large S&P 500 contract to become the dominant equity index futures vehicle. What Sarao discovered was elegant in its simplicity. The market's electronic order book responded predictably to large orders. He could place massive sell orders, sometimes worth $200 million, to create artificial downward pressure, then cancel them before execution. As genuine buy orders rushed in to fill the apparent gap, Sarao profited from the microsecond scale price movements his spoofing triggered. The E-mini market operated on pure electronic order books, where deep liquidity and tight bid-ask spreads created the perfect hunting ground for someone who understood the system's mechanical responses. From 2009 to 2014, Sarao ran this play thousands of times, aided by custom-modified software that let him flood the order book and cancel positions faster than most traders could blink. Between 2009 and 2014, his trading netted approximately $40 million, all from a desk in his childhood bedroom, cluttered with computer monitors and wires. By early 2010, Sarao had turned his parents' suburban home into an operation capable of moving markets worth trillions. What he didn't realize was that he was about to test his system against the most volatile trading day in modern history. Sarao began his market manipulation in 2009 with commercially available trading software, whose code he modified to rapidly place and cancel orders automatically. The modification was crucial. Standard trading software couldn't execute the precise timing and volume of orders required for his technique. Spoofing works by placing false orders to create a misleading impression of market demand or supply. Layering, also called, quote, stuffing, places multiple orders at different price levels on one side of the order book. Sarao combined both into what prosecutors would later call dynamic layering. Here's how Sarao executed it. He'd place a genuine small sell order, the trade he actually wanted to execute. Then, using his modified software, he'd flood the order book with massive buy orders at successively higher prices, creating the illusion of enormous buying pressure. Sarao placed huge sell orders, from 35 to 85 times the average market size, across multiple price steps. Other traders, seeing this apparent wall of demand, would rush to buy at higher prices, driving the market up exactly as Sarao intended. The moment his small sell order filled at the artificially inflated price, Sarao would cancel all the fake buy orders in milliseconds. This rapid cancellation prevented him from actually taking on substantial positions while manipulating the market without committing to the orders he initially placed. He had moved the market without ever committing to the positions he'd placed. He had extracted profit from a distortion he created, using orders he never intended to fill. The market would snap back to its natural level, but Sarao had already captured his profit from the temporary distortion. By 2010, Sarao had perfected this system into a precision instrument capable of moving billions of dollars in market value with the click of a mouse from his cluttered bedroom in suburban London. So Sarao's spoofing technique using massive fake orders worth up to $200 million, was that technically legal when he started, or was he breaking the law from day one? Comment your thoughts below. Spoofing was already illegal before the 2010 Dodd-Frank Act specifically prohibited it, defining it as bidding or offering with the intent to cancel the bid or offer before execution. Drop your answer in the comments below. Now let's see what happened when Sarao's system collided with the most chaotic trading day in modern history. By May 6, 2010, Sarao had perfected his spoofing system into a precision instrument. Markets opened down 4% on concerns of a potential Greek sovereign debt default. By 2:30 p.m., the VIX had spiked 22.5% from the open, and the Dow Jones Industrial Average was down 2.5%. At 2:32 p.m. Eastern Daylight Time, a $4.1 billion sell program hit the E-mini market, a mutual fund complex hedging an existing equity position by selling 75,000 contracts. Sarao had already been active since morning. Between 11:17 a.m. and 1:40 p.m., he deployed his layering technique continuously. Between 12:33 p.m. and 1:45 p.m., he added spoofing, creating downward pressure that primed the market for what came next. What happened revealed how fragile the electronic system had become. High-frequency trading algorithms programmed to buy and resell contracts while capping inventory began a feedback loop. In 14 seconds, they traded 27,000 contracts, 49% of total volume, while buying only 200 contracts net. The market became a hall of mirrors, each algorithm responding to phantom demand Sarao had created. At 2:42 p.m., the Dow dropped an additional 600 points in 5 minutes. By 2:47 p.m., it had fallen nearly 1,000 points for the day. Sarao's spoofing had collided with the mutual fund's massive sell order and the market's own infrastructure, creating a cascade that would temporarily erase $1 trillion in value. From his bedroom in Hounslow, Sarao netted $879,018 in profits that day, the moment his system exposed Wall Street's deepest vulnerability. At 2:47 p.m. on May 6, 2010, chaos erupted in the E-mini market. Between 2:40 p.m. and 3 p.m., over 20,000 trades executed at prices 60% or more away from the 240 baseline. Individual stocks began trading at absurd levels. Accenture fell from $40 to 1 penny, while others spiked to $100,000 per share. The algorithms powering modern trading had turned the market into a hall of mirrors, each system reacting to phantom signals created by Sarao's spoofing technique. Sarao's modified software had flooded the order book with massive fake orders, while his genuine small sell orders filled at artificially inflated prices. As other traders' algorithms detected what appeared to be enormous buying pressure, they rushed to buy at higher prices, driving the market exactly as Sarao's system intended. But on May 6th, something different happened. The high-frequency trading systems that dominated the market began feeding off each other's reactions. When Sarao's layering orders hit the market alongside the natural volatility of the day, the algorithms amplified the distortion exponentially. Each cancellation triggered cascading sell-offs. Each sell-off triggered more algorithmic selling. Within 36 minutes, $1 trillion in market value had evaporated. The SEC and CFTC investigation, completed September 30, 2010, identified Sarao's dynamic layering as a significant contributor to the order imbalances that destabilized the derivatives market and rippled into stocks. But the investigation also revealed something more disturbing. Sarao's technique had exposed a fundamental weakness in the market's architecture. The system wasn't designed to handle someone who understood its mechanical responses better than its creators. From his bedroom in Hounslow, Sarao had discovered that modern markets, built for speed and interconnection, were vulnerable to precisely the kind of pattern exploitation he'd spent 5 years perfecting. On April 21, 2015, nearly 5 years after May 6, 2010, the U.S. Department of Justice indicted Navinder Singh Sarao on 22 criminal counts including wire fraud and spoofing. Scotland Yard arrested him at his Hounslow residence that morning. The investigation had taken years because regulators were essentially tracking microsecond-scale order patterns across multiple exchanges. Sarao's $200 million in sell orders had been replaced or modified 19,000 times before cancellation, a pattern so intricate it required forensic reconstruction of millions of trades. What the investigation revealed extended beyond Sarao's individual actions. The CFTC concluded Sarao was significantly responsible for the order imbalances that exacerbated the flash crash. But the crash had exposed a systemic vulnerability. Regulation NMS, designed to modernize the national market system for equity securities, had inadvertently created new exploitable gaps. The system meant to protect investors had fragmented liquidity across venues in ways that made mechanical manipulation possible for anyone who understood the infrastructure deeply enough. Sarao entered a guilty plea to wire fraud and spoofing, facing up to 8 years but receiving 1 year of supervised release. He cooperated with authorities, providing keen insights and explanations regarding patterns of deceptive and manipulative trading that illuminated how widespread such exploitation had become across the industry. His case revealed that the world's most sophisticated financial markets operated on systems vulnerable to anyone who grasped their mechanical responses. Sarao had extracted approximately $40 million from 2009 to 2014, all from his childhood bedroom, before losing most of it to fraudulent investments. The trader who had gamed Wall Street's infrastructure had himself been gamed, a fitting coda to a story that exposed how fragile the entire system had become. Hit subscribe for more stories about how systems really work, and watch the next episode.